Let me tell you a story about how Palantir stock skyrocketed to the moon. And no, it wasn't some big earning report or groundbreaking product release. The secret? It joined the S&P 500, and mutual funds had no choice but to buy it. The same exact thing is about to happen with ticker symbol XYZ, known as Block, and here's why. When companies enter the S&P 500, it triggers a domino effect. Funds that mirrors the index are forced to buy the shares, creating a sudden rush of demand that drives up the stock price. Why do stocks like X, Y, and Z experience sudden spikes in price when they're added to the S&P 500? The answer isn't guesswork or corporate popularity. It's rooted in mathematics, and it starts with understanding the S&P 500 itself. The S&P 500 is more than just a list of 500 large companies. It's one of the most followed stock indexes in the world, and with good reason, trillions of dollars are tied to it, either passively through funds that track the index or actively by investors who uses the S&P 500 as a benchmark to track performance. Essentially, when this index moves, it ripples through global market. But this influence also reveals some intriguing mechanics when it comes to what happened when a new stocks like X, Y, and Z Block joins the list. Here's our key takeaway. Funds that mimic the S&P 500, like many mutual fund and exchange traded fund, ETF, aren't just casually observing the index. They're engineering to track it down to every single stock. The instant a new company is added, these funds have to buy its shares, often in massive quantities, to maintain the perfect alignment. They're not weighing their options or choosing what they believe will perform best. The hands are tied. If X, Y, and Z gets added, the funds must adjust accordingly whether or not they believe X, Y, and Z is a good investment. To visualize this, think of a domino effect. A single event like a stock entering the S&P 500 sets off a chain reaction. Once the announcement is made, these tracking funds starts making their move. Billions of dollars flow into buying shares, not because there's anything fundamentally new about the company, but because the rules dictate they must. This mechanical buying causes stock price to jump, sometimes dramatically. Take a step back for some perspective. According to the recent data, over 7 trillion in assets are benchmarked to the S&P 500, or more than 5 trillion directly tied to passive funds that replicate the index. Think about what that means. Even when a fraction of this money shifts to buy shares of a newly included company, the impact can shake up the stock price. A study from the S&P 500 index highlighted this effect, showing that between 1995 and 1999, stocks added to the index outperformed the S&P 500 itself by an average of 8.3% in the short term between the announcement date and the official inclusion date. But here's what makes this even more fascinating. None of this sudden price movement is tied to the company's actual performance, like its revenue, profit, or growth. It's entirely driven by a surge in institutional buying, which is automatic and unavoidable. This can cause confusion to new investors who see this price spike and assume it reflects a dramatic shift in companies' prospects. In reality, it's not a reflection of the fundamentals, it's simply a mechanical behavior of index track. Imagine this in a different context. Let's say a local store decides to carry a new product. Suddenly, because it's available everywhere, consumers starts buying it, not necessarily because it's better than its alternative, but because it's more convenient and widely promoted. Product hasn't changed, but demand increased simply because of its visibility. That's essentially what happens when a company like X, Y, and Z gets added to the S&P 500. It becomes a must-buy for funds representing millions of individual investors. It's important to note that this effect doesn't create value out of thin air. The price jumps is temporarily and often stabilized once the initial buying frenzy settles down. Studies have shown that while there's typically a pronounced surge in the short term, the index effect on the stock price diminishes over time. More recently, the jump may still happen, but the percentage can vary depending on the market's condition and specific company. So why does this matter? If you've been watching X, Y, and Z and wondering whether the stock's sudden rise is a sign of something deeper, this explains the real reason behind the move. When you strip away the mechanics, all you're left with a system that forced money to flow. Not because the stock is suddenly more valuable, but because buyers have no other choice. It's predictable, it's not random, and it's tradable. And XYZ isn't alone. Companies like Coinbase and Palantir have shown exactly how big the short-term impact of S&P 500 inclusion can be. They're a prime example of how this plays out, and there's a lot to learn. Remember Coinbase and Palantir set headlines soaring after being added to the S&P 500? Those price jumps weren't just hype. They were a byproduct of a financial ripple that both predictable and fascinating. Let's break it down. Coinbase made a dramatic entrance into the S&P 500 on May 19, 2025. But the action started long before. As soon as the announcement was made on May 13th, investors saw Coinbase stock jump 24% in a single day. To put that into perspective, this was the sharpest rally for the company seen after the day of the 2024 election. The timing here wasn't coincidental. This fund had to secure Coinbase shares no matter what the cost was, which pressured the price to climb rapidly. The inclusion set off a buying frenzy, particularly among investors obligated to track the S&P 500. This fund had to secure Coinbase shares at no matter the cost, which pressured the price to climb up rapidly. Palantir's story was remarkably similar. On September 11, 2024, the announcement hit that Palantir would be joining the S&P 500. The next trading session, the stock shot up 13%. Again, this wasn't due to earnings, a game-changing product launch, or any improvement on its business fundamental. The price jump was direct result of demand created by institutional investors who had to align their portfolio with the index. The price surge wasn't about the companies being more valuable, it was about the mechanics of the inclusion and the sheer volume of the stocks these funds were forced to buy in the short term. The price surge wasn't about the company being more viable, it was more about the mechanics and inclusion and the sheer volume of stocks these companies were forced to buy in a short period of time. To understand why this happened, think about a store. Imagine a regular product on the shelf, one that's always been there, unchanged, and suddenly it goes viral on TikTok or Instagram. And people rushing to grab it. Not because the product itself is special or new, but simply because the demand for it increased and people want to buy it or just have it so they can post on social media. The product didn't approve. It just becomes something that suddenly everyone had to have. Same with Coinbase and Palantir and stocks that was added to the S&P 500. The same dynamic exists. The product in this case, the company, hasn't changed, but the demand did. This isn't isolated to these two companies only. Historically, stocks added to the S&P 500 between 1995 and 1999, for example, outperformed the index on an average of 8.3% from the day their inclusion was to the end. To put numbers into perspective, Coinbase's 24% single-day rally points to the magnitude of demand forced onto these stocks. With Palantir, the jump exceeded 13% in one trading day session. And this is not just the headline percentage increase that tells the story, it's the mechanics behind the move. Each fund manager aligned to the S&P 500 has a legal obligation to allocate the same basket of stocks. And this includes freshly added companies regardless of what the market thinks of the prospects. The sheer number of funds mirroring the S&P 500 creates a built-in audience that doesn't have the luxury of choosing whether they want to participate, they must participate. Seeing these trends repeated with Coinbase and Palantir should tell you that the inclusion in the S&P 500 isn't about rewarding a company performance or potential. It's about the system fueling artificial demand. For short-term traders, moving like this can feel like an opportunity, but for long-term investors, it's critical to be very safe and do your research before jumping in. But why is it so important? Because spotting this pattern gives you a window of how the market works. Understanding the role of index funds and institutional buying can help you make smarter decisions. S&P 500 inclusion doesn't mean the company has suddenly become better or more valuable. It simply signals that institutional investors, like index funds, are required to buy its stock. This mechanical demand can create a short-term spike in price, but those increase doesn't always reflect the company's true growth or financial health. By understanding this process, you can spot predictable market move and avoid placing too much weight on inclusion-driven surge. Instead, focus on the fundamentals like revenue, profit trends, and future potentials. Remember, the market rewards understanding and knowing how it works and set realistic expectation and make better investment decisions. That's it for today, folks. Don't forget to like and subscribe to the channel and click on the link below if you need help with bookkeeping or accounting services, and also join the community as well. Thank you for tuning in and see you next time.